Welcome back to the Deep Dive, where we take the complex stack of source material, the policy shifts, the surprising earnings reports, and the technical signals, and distill them into the knowledge you need without the information overload. Okay, let's unpack this. Today we are tackling one of the most consequential mixes of signals we've seen all year. We're navigating a real pivot point. You've got the Federal Reserve's recent rate action, you have equity markets sitting, stubbornly near all-time highs, and then this rapidly shifting landscape in AI and crypto as we look toward 2026. This requires some serious analysis.
That's exactly right. It's a highly nuanced environment, and it's driven equally by policy communication and, well, investor psychology. Our mission here, and this is purely for educational purposes, is to bring some clarity to those conflicting signals for you. We need to look beyond the headlines.
Yeah, get into the mechanics of it. So here's where it gets interesting. Let's start with the Fed, because they gave us a real head-scratcher. They delivered a rate cut, which you'd think is accommodative. But the market's reaction suggests something, well, a lot more complicated. What do we actually get from them?
We got immediate gratification, but with a very stern warning label attached.
A warning label.
Yeah. They delivered the cut, which was, the near-term relief the market wanted, and the policymakers' tone was noticeably more measured, softer, which is good. But then you look at the dots, the long-term projections, especially for 2026, they suggested fundamental structural restraint.
So it's sort of like, okay, use an analogy here. It felt like the Fed gave us a glass of water, but then they dramatically took the pitcher away and put it back on a high shelf.
That is an excellent way to frame it. You hit the nail on the head. That combination, immediate relief, followed by a tempered expectation for any aggressive, sustained easing cycle, that is precisely what defines this hawkish cut.
Okay, so a hawkish cut. And the critical question is, why? Why did they feel confident enough to cut now, but still feel the need to, restrain expectations for the future? It all comes down to their inflation forecast, doesn't it?
It does, completely. Their commentary on inflation dynamics was the linchpin of this entire decision. They outlined a very specific trajectory. They expect inflation pressures, and that includes the sticky elements influenced by tariffs and so on, to peak early in the new year.
A peak early.
And then, crucially, they expect them to gradually subside afterward.
So if that forecast actually holds, if inflation just naturally cools down in the first half of the year, then the Fed doesn't need to panic. They don't need to slash rates aggressively in 2026.
Exactly. The need for that aggressive accommodation just disappears if inflation does the heavy lifting for them. And what's so fascinating is that this clear, calm guidance, it seemed to stabilize asset prices more effectively than a bigger rate cut might have. Certainty can matter more than the rate itself.
Okay, so the policy signal is clear. Near-term relief, long-term discipline. But let's look at the actual scoreboard. The S&P 500, other major indices, they're still near all-time highs. This is such a striking contrast to what I think a lot of individual investors are feeling. Why are indices at records if portfolios feel like they're struggling?
That contrast should be a red flag for every investor. I mean, if you're sitting there feeling like your personal portfolio is lagging, but the major averages are hitting records, you have to realize the issue might not be the market conditions.
Right.
The issue is likely structural. It's centered on individual risk management, maybe concentration, or your strategy's composition.
So structural weakness that's just being masked by a high tide, what does that look like in practice?
Well, sustainable markets, and we are in a very extended one, they're excellent at masking these weaknesses. Maybe you're over-concentrated in a few names, or your strategies, they just lacked proper hedging. These things don't get exposed until volatility spikes.
And it will spike eventually.
It always does. So this isn't a market signaling a lack of opportunity. It's signaling a severe need to prepare for a pullback.
We also noticed a technical detail that kind of supports this idea of masked weakness. Recent advances have been on relatively light volume. What does that tell us? What's the conviction behind these all-time highs?
Light volume is like a marathon runner crossing the finish line with no one cheering.
Ah, okay.
It means the momentum is there, but that broad participation, the strong conviction from big institutional money, it's just lacking. Prices are being pushed higher by fewer dollars.
And high prices on low volume, that usually means the market is frothy, right?
It does. It just reinforces that idea that the market is frothy and vulnerable. It means we're susceptible to sudden corrections, either from a macro shock the Fed didn't see coming or just, disappointment on corporate earnings. After this rally we've seen, a period of sideways consolidation would be healthy. Frankly, it would be expected.
Okay, let's move to the engine room then. The real fuel for any advance, regardless of what the Fed does next. We're talking about economic growth and corporate earnings.
These are the pillars. The key requirement for a continued advances. It's actually pretty simple. If GDP growth remains resilient, so the economy is expanding at a steady pace, and corporate earnings continue to expand, markets absolutely can advance further.
So they can climb on performance alone.
Exactly. Assuming the economy holds up, it's a mechanism of demand and pricing power. When GDP is resilient, consumers spend, businesses invest. That demand lets companies maintain pricing power, boosting revenue and, crucially, their margins. If that cycle breaks, the market loses its reason for being at these highs.
And we can't forget the global context, right? The
Yes.
silent partner in all this, global liquidity.
Liquidity conditions are still highly supportive globally. And this is a subtle but very potent driver. You have central banks all over the world navigating these massive elevated national debt levels, and the policies they use to manage this debt, they indirectly favor asset prices.
It's the tide that lifts all boats.
It is. And historically, that tide can support risk assets for a lot longer than people who are anticipating a crash usually expect.
So the overall tide is high, but the individual engines, individual stocks, can still sputter. Which brings us directly to the recent volatility in tech, specifically around AI. The market just reminded us that even the most powerful theme has selective risk.
Absolutely. The disappointing earnings from Oracle and even the, temporary weakness we saw in a name like NVIDIA, that was a crucial reality check. The market is moving past the AI hype phase.
And
the AI execution phase. Investors are now demanding proof. Proof of execution, funding capacity, and sustainable margins. They are hypersensitive to two specific things: capital intensity and balance sheet health.
How much a company has to spend just to keep up?
Exactly. Building massive data centers, buying expensive chips. The question investors are asking now is, can you sustain this investment and show a profit? Or are you just going to burn through cash?
But not every company that slaps AI in their press release is going to benefit equally.
Precisely. It requires being highly selective. You need proof of concept, not just a promise. But the counterpoint here is vital. The underlying structural strength of the AI infrastructure leaders remains solid. Demand for advanced computing, for data centers, that has not deteriorated. The trend is intact. It's just the stock prices that are consolidating.
Right, looking for better entry points. That structural strength leads us to where the specific opportunities are. In idiosyncratic catalysts, not just broad sector beta. Can you explain that? What's an idiosyncratic catalyst?
Sure. Think of broad beta as the whole market moving together. The S&P goes up, most stocks go up a bit too. An idiosyncratic catalyst is a company-specific event that drives its stock price, independent of the market. It could be an M&A announcement, a new product, a big cost-cutting plan.
So specific news about a Netflix or a Meta is more important right now than the daily churn of inflation reports.
Exactly. Those names are attracting capital because of those specific stories. Take Netflix. It saw some recent weakness, right? And that was tied to uncertainty around a potential acquisition, dilution risk. The underlying business is great, but the stock reacted purely to that specific event. Resolve that uncertainty, and you could get a massive stock-specific re-rating.
Which brings us to maybe the most fascinating factor right now, investor psychology. We've had these repeated rapid recoveries from pullbacks over the last few years. What is that doing to people's behavior?
It is conditioning us.
Yeah.
It's effectively trained investors to buy the dip with a lot of confidence. This pattern, it's often driven by recency bias, fear of missing out. It can extend trends way beyond what traditional valuation would suggest.
But the danger you mentioned is that this also sets us up for a much sharper fall.
It increases the risk of a really violent, aggressive correction when sentiment finally shifts. If everyone rushes in to buy the dip and suddenly that dip turns into a crater.
And it doesn't bounce back.
Right, it fails to recover quickly. The reversal of confidence can be brutal. Those dip buyers turn into forced sellers very, very quickly.
Okay, let's briefly touch on the parallel market, crypto, before we wrap this up.
Yeah.
Still volatile, dominated by large players, but the adoption narrative is persistent. How are investors approaching it today?
We see two really distinct approaches. First, you have confirmation-based strategies. These investors are patient. They're waiting for clear technical signals, like a sustained break above a major resistance level before they commit capital. They want confirmation the trend is real.
They wait for the market to tell them it's time to go.
Precisely. The second group uses systematic accumulation. This is based on long horizon conviction, particularly for an asset like Bitcoin. They ignore the short-term noise, and they just do disciplined dollar-cost averaging. They believe in the long-term value, regardless of the month-to-month price swings.
And both of those strategies, different as they are, they really underscore the same universal rule, don't they?
They absolutely do. Strategic consistency is essential. We've seen it time and again. Following partial strategies like buying without an exit discipline, it just leads to poor outcomes. Markets reward patience, they reward preparation, and above all, they reward adaptability.
So what does this all mean? Let's summarize the outlook for the listener as we head into 2026. Combining this hawkish cut, the frothy highs, and the selective nature of growth.
You should expect periods of significant volatility, but alongside continued opportunities. It will not be a straight lineup. The environment's going to be heavily influenced by politics, by fiscal policy, and how central banks keep managing global liquidity.
And if that volatility hits, if we see that 10 or 20% pullback that history tells us is always possible, what should a disciplined investor be doing?
They should be prepared to act. Historical precedent tells us these pullbacks are not signals to exit the market in a panic. They're the periods disciplined investors should use to build positions in companies and assets they have long-term conviction in, taking advantage of the fear.
That is the essential message. Okay, let's recap the three most important insights for you to take away from this deep dive. First, the Fed delivered a hawkish cut. They gave us near-term relief, but their 2026 projections severely restrained expectations for aggressive future easing. And it's all contingent on inflation peaking early in the year. Second, equities are frothy near all-time highs, characterized by light volume. This lack of conviction masks structural weaknesses. The focus should be on shoring up your individual risk management now before volatility exposes those weaknesses. And third, the AI opportunity is becoming highly selective. The market is moving past the hype. It's demanding concrete proof of execution, a funding capacity, and sustainable margins, even though the underlying demand for computing is still incredibly strong.
And here's the final provocative thought for you to consider. Success in this environment, it depends less on predicting the exact moment the market turns, and far more on maintaining a flexible, disciplined framework to handle that turn when it arrives. So the critical question isn't where the market will be in mid-2026, but how prepared are you to act with clarity when that inevitable volatility hits? What specific signal would cause you to adjust your framework right now?
Food for thought indeed. Thank you for joining us for this deep dive. We hope this analysis gives you the perspective you need to navigate the coming quarters.